Wall Street's dangerous new obsession with farmland. The auction yard is silent except for the wind rustling through dry corn stalks. Mark Davis stands with his father, boots coated in the same soil their family has worked for nearly a century. Across the field, a man in a tailored suit raises his hand. Another bid, then another. The number climbs past what any working farmer could ever afford. Mark's father lowers his head, years of sweat, gone with one wave of a pen. The winning bid doesn't come from another farmer. It comes from a corporate investment firm. That firm doesn't plan to plant anything. They plan to hold the deed. For them, this land isn't about food, it's about yield. To understand how farmland became a financial asset, we need to rewind. After the 2008 financial crisis, Wall Street went looking for safety. Stocks had crashed, housing imploded, and investors wanted something that couldn't vanish on a spreadsheet. They found it under their feet: soil. Productive farmland, they realized, doesn't go bankrupt. People will always need to eat. Farmland quietly transformed from a livelihood into an asset class. Institutions began buying thousands of acres at a time. Pension funds, billionaire investors, even universities. They called it diversification. But for farmers like Mark, it meant being priced out of the only life they knew. Here's the unsettling part. What happened to housing is now happening to food. Homes became securities in the 200s. Loans were bundled, sold, and leveraged until the system collapsed. Now, investors are packaging land itself, turning fields into financial products that trade on Wall Street. When farmland becomes a spreadsheet entry, it changes what the land is for. The goal shifts from feeding families to pleasing shareholders. And just like housing, the prices don't stay tethered to reality. Farmland that once sold for $3,000 an acre can now go for over $10,000, even when crop prices haven't risen. Farmers accustomed to handshakes and family legacies now face portfolio managers chasing returns. It's not that agriculture suddenly became more productive. It's that money decided it belonged there. Firms pitch farmland as a safe hedge, uncorrelated with the stock market. Real estate trusts lease land back to farmers, turning them into tenants on what used to be their own property. The pitch is clean, modern, and data-backed. Yet beneath all the spreadsheets is the same story that's played out across American capitalism. When necessity meets speculation, the necessities lose. Housing showed that pattern. Food follows next. To grasp how powerful this shift is, consider who's buying. The list reads like a roll call of global capital, BlackRock, TIAA, and the world's wealthiest private investors. Among them, Bill Gates, now the largest private farmland owner in the United States. His portfolio spans more than 240,000 acres across 19 states. Cascade Investment, his financial arm, made a $520 million deal to acquire a farmland REIT in 2017. It wasn't about becoming a farmer. It was about owning an asset that never goes out of style. Meanwhile, financial blogs and investment platforms praise farmland returns: steady, inflation-resistant, and reliable as gold. Farmland used to be a calling. Now it's a trend. Old barns rot while new financial products promise exclusive access to agricultural alpha. That language doesn't speak to planting seasons or irrigation. It speaks the language of finance: yield curves, cap rates, liquidity. Words that make sense in boardrooms, not in pastures. Yet decisions made in those boardrooms now decide who eats, who farms, and who gets priced out. The stakes couldn't be higher. Whoever controls the food supply controls the price of life itself. We've already turned houses into speculative tokens. Now, the same experiment is expanding to farms, with lessons unlearned and consequences unseen. So here's the central question this story will ask. How did Wall Street transform farmland into its newest gold rush? And what happens when the last farmers standing are answering not to the soil, but to shareholders? That day, standing by the fence, Mark Davis didn't lose just land. He lost the thing that grounded his family for 4 generations. As the corporate rep signed the deed, Mark's father said softly, "It's not our farm anymore." No one realized back then it wasn't just his family's story. It was a glimpse of America's next financial frontier, where the commodity isn't crops or houses. It's the ground beneath both. The great land grab. The story really starts after everything else fell apart. When the financial markets crashed in 2008, investors got burned. The housing bubble had popped, stocks were in freefall, and the safe bets suddenly weren't safe anymore. But one thing still stood quietly strong through the chaos: farmland. While portfolios evaporated and mortgages collapsed, the value of soil held steady. People still needed to eat, crops still grew. That stability caught Wall Street's eye. At first, farmland looked like a backup plan, a low-risk refuge for shaken investors. But the idea spread fast. Major institutional players started to connect the dots. Here was an asset that produced consistent returns, moved opposite the stock market, and could hedge against inflation. The logic was simple. Every day, billions of people ate food. Those calories started somewhere, and whoever owned the land beneath, that process owned the foundation of the entire economic chain. So starting around 2009, the land rush began. Firms that used to trade derivatives turned their attention to corn, wheat, and soybeans, not by growing them, but by buying the dirt they grew in. Pension giants like TIAA created farmland funds worth billions. Private equity groups and insurance firms built sprawling portfolios. By 2014, institutional investors managed tens of billions of dollars in farmland assets worldwide. The timing wasn't accidental. As central banks pumped money into the economy, cheap borrowing inflated asset prices across the board. Those easy loans trickled into rural America, where investors could leverage debt to buy large tracts of farmland. A pension fund in New York could suddenly outbid a fifth-generation farmer in Iowa without ever leaving their office. And that's exactly what happened. Local auctions that once drew neighboring families began filling with financial representatives. Unknown bidders dialed in remotely, pushing up prices beyond anything linked to actual crop revenue. Land that had stayed in a family for generations sold off in an afternoon. To the funds, it was a sound diversification play. To the people living off the soil, it was dispossession by spreadsheet. BlackRock, the world's largest asset manager, started analyzing farmland as part of its real assets division. Hedge funds like Man Group rolled out dedicated agricultural strategies. Investment platforms cropped up, promising everyday investors the chance to own a piece of American agriculture through fractional shares. Everything about farmland, not just its produce, but the soil itself, was being financialized. Meanwhile, prices began to skyrocket. The average cost of North American farmland doubled between 2008 and 2022. In some regions, it tripled. Small farmers used to gauge land value by yield, how much wheat or corn it could grow. Financial buyers calculated it based on return percentages, discount rates, and inflation projections. The metrics diverged, and suddenly the market did too. That's when independent farmers began to disappear from the bidding tables. They couldn't compete with funds promising 8 to 12% annualized returns. Each sale tilted the scale further. When neighbors sold, local economies shifted. Rural banks saw loan demand fall as family farms vanished. Seed and feed stores lost customers. Entire towns started to feel the emptiness. The land itself changed hands quietly, often through shell companies or limited partnerships that disguised true ownership. One tract might be held by Prairie Investments LLC, another by Harvest Acquisitions II, but they all linked back to the same financial pipeline. By the mid-200s, foreign investors joined in. Sovereign wealth funds from the Middle East and Asia began purchasing U.S. acreage as a geopolitical hedge. To them, farmland wasn't part of a national identity. It was exposure to food inflation protection. Farm economists at universities tried to warn about what they called asset detachment, the widening gap between farmland's productive value and its traded price. But warnings were easy to ignore because on paper, everyone looked richer. Counties posted record land valuations. Tax revenues climbed. Politicians praised investment in rural America. Few stopped to ask whether those investors would ever plant a seed. In this environment, figures like Bill Gates stood out not because they started the trend, but because they personified it. Gates's Cascade investment quietly rolled up over 240,000 acres of farmland, structured through dozens of LLCs. The media fixated on him, but his presence only highlighted a broader shift. Farmland had become the new Silicon Valley, promising steady returns instead of disruptive innovation. Even if the crops failed, the land's long-term scarcity guaranteed appreciation. What no one planned for was what these transactions did to the next generation of farmers. Young people raised on farms already faced tight margins and tough access to credit. Now they were priced out entirely. The American Farmland Trust estimates that nearly 40% of farmland will change hands within the next 2 decades, but fewer and fewer of those new owners will be actual farmers. Most will be institutions. Each purchase also concentrated power. Where once ownership was scattered among hundreds of local families, now a handful of trusts and asset managers hold millions of acres. Farm policy, crop choice, and even soil management increasingly respond to investor expectations rather than community needs. An analyst in a New York office weighs water use and fertilizer costs the same way they might analyze risk in an office REIT. Underneath all of this ran another insight investors couldn't ignore. Farmland wasn't just dirt, it was water. Many state water allocations are tied directly to land ownership. When a Wall Street firm buys acres in Arizona or California, it gains control over the aquifers beneath them. That control can be more valuable than the crops the land can grow. With drought tightening its grip on the West, investors realized water rights could appreciate even faster than real estate. As a result, speculation in arid regions surged. Firms began to describe water as blue gold, emphasizing its scarcity value in earnings calls. Private equity groups funded water management companies that served as intermediaries, allowing investors to acquire acreage primarily for the attached rights. Once that connection clicked, the line between farmland and finance blurred completely. The field itself became a financial instrument. For farmers, all this meant new kinds of landlords. Instead of neighboring families or local cooperatives, they now answered to fund managers tracking quarterly returns. Lease contracts included clauses about minimum yields and technological adoption. If profits slipped, the land could be sold, subdivided, or repurposed for solar leases. Farming became a temporary occupation in service of permanent asset management. And yet, to outsiders, it looked like prosperity. Reporters noted rising land values as proof of rural revival. Real estate agents celebrated multi-million-dollar auctions. Investors boasted that their farmland portfolios had never lost money in over a century. But the story on the ground was the opposite: consolidation, rising barriers to entry, and an ever-shrinking group of actual producers. By the end of the 200s, institutional landlords controlled millions of acres across the Midwest, the Delta, and the West. Wall Street had successfully colonized the countryside. Fields once passed down through families were now investment vehicles, strategic holdings in a global portfolio mix. It was the great land grab, and it was only the beginning. The shift might have ended there if farmland were just soil. But as investors soon discovered, the real treasure lay beneath the surface. Because whoever owns the land doesn't just control what grows on it, they control what flows through it. And that realization would carry this story into an even higher stakes arena: water. The water connection. It starts with a fact most people don't realize. Owning farmland isn't just about the surface. In much of the United States, when you buy land, you're also buying the rights to the water underneath or flowing through it. That invisible asset, water, is what transforms farmland from a simple investment into a strategic weapon. In the past, farmers and communities used and shared their water locally. But once Wall Street discovered that water rights could be monetized, the ground itself became a vessel for financial leverage. In places like Arizona, California, and Colorado, the value of an acre is now determined less by what can be grown on it and more by what flows beneath it. When hedge funds began purchasing farmland in these regions, they quickly learned that an acre with secure water rights could be worth several times more than one without. That realization triggered a quiet but powerful shift in motivation. Investors weren't just buying earth. They were buying access to something that's becoming scarcer every year. Take the American Southwest. It's in the midst of the worst megadrought in 1,200 years. Farmers who once relied on steady irrigation from aquifers now see wells drying up. Yet, many of those same aquifers are being tapped by corporate farms or absentee owners trying to maximize short-term yields. Deep wells, powerful pumps, and massive water withdrawals move irrigation water miles away from communities that have depended on the same water sources for generations. In Arizona's La Paz County, residents watched quietly as out-of-state investment funds began buying large tracts of farmland. At first, it seemed harmless, just another real estate transaction. But soon, drilling rigs appeared, boring thousands of feet down to tap the valley's groundwater. Within a few seasons, the water table dropped, and family wells began to run dry. Some farmers had to deepen their wells at enormous cost. Others abandoned their fields altogether. When local officials asked the new corporate owners to adjust usage, they were told everything was completely legal. And it was. That's because water rights law in the western United States was built around a doctrine called first in time, first in right. Whoever first claimed the water decades ago and attached it to land deeds still controls it today, regardless of modern ecological realities. Investors exploited this relic of the 19th century, buying up land with senior water rights and diverting those resources to where they could earn the highest financial return. Sometimes that meant selling water to nearby cities or bottling companies instead of using it to grow food. In those transactions, the crops were incidental. The water itself was the real harvest. Michael Burry, the investor famous for predicting the 2008 housing crash, was among the first to understand this. After shorting subprime mortgages, he turned his attention to agriculture, but not for the crops. He bought farmland with strong water rights, calling them the purest way to invest in water. His strategy spoke volumes about the direction the market was heading. He wasn't alone. BlackRock, TIAA, and other investment giants started flagging water sustainability as a core investment theme. Water Asset Management, a New York-based fund, spent over $100 million buying Arizona farmland specifically to secure its groundwater rights. Locals called it a water grab. As these purchases accumulated, something fundamental changed in the balance of rural power. Control over water once rested in the hands of local irrigation districts, small communities, and state agencies meant to balance competing needs. Now, some of that control has shifted to private investment firms whose fiduciary duty is to maximize returns, not to preserve resources. When you treat water as a financial asset, conservation becomes a secondary concern. The problem isn't confined to the desert. In California's Central Valley, industrial almond and pistachio orchards financed by corporate capital dominate landscapes that use to support diverse crops. Those orchards draw billions of gallons of water annually, often from dwindling aquifers. Because tree crops require watering every year once planted, farmers can't simply fallow fields when water shortages hit. Investors know this, and many use debt restructuring to squeeze every bit of production out of the land until the aquifers are empty. When the wells run dry, they move on. Meanwhile, small farmers are stuck fighting for what's left. Consider the story of the Romeros, a third-generation family in Kern County. For decades, they irrigated 120 acres with well water that had sustained their almonds and grapes. But after corporate farms bought thousands of acres nearby, drilling deeper and faster, their wells started coughing up sand. Within 2 years, their aquifer level had fallen by more than 100 feet. The Romeros tried to dig deeper, but between drilling costs and rising electricity prices, they couldn't keep up. Eventually, they sold the land, ironically, to one of the very companies that drained them. Across the West, local residents have watched a new kind of speculation unfold. Water rights, once tied to the public interest, are being treated like tradable commodities. In some states, opaque water markets allow owners to lease or sell their rights independently of the land. It's perfectly legal for an investment fund holding agricultural water rights to transfer that water to municipalities or industrial users miles away. Each transfer can yield profits without planting a single seed. That's how farmland becomes a front for something far more valuable: liquid capital disguised as soil. Regulatory loopholes make this possible. Federal law barely touches groundwater allocation. State-level oversight often relies on outdated data or voluntary reporting. This leaves space for speculative trading of resources that entire communities depend on. The legal framework can't keep up with financial innovation. What started as a hedge against inflation is now reshaping the geography of water itself. And there's an even deeper irony. As investors boast of sustainability and green portfolios, many of their holdings actively worsen resource depletion. Corporate-led farms deploy sensor networks and algorithmic irrigation aimed at efficiency. But efficiency in this context usually means wringing the maximum short-term yield from a constrained aquifer. Every gallon that flows through those systems is a line item on a spreadsheet, not a shared public resource. When journalists ask about these deals, investment managers use the same rehearsed phrases: long-term stewardship, responsible resource allocation, sustainable yield. But the numbers tell the truth. In regions with heavy investment ownership, groundwater depletion has accelerated. The U.S. Geological Survey estimates that parts of the Central Valley have sunk by as much as 30 feet due to overpumping. Once the ground collapses, those aquifers can never naturally refill. The land literally sinks under the weight of financial pressure. The logic driving this is familiar. As scarcity increases, so does value. Investors know that water scarcity itself boosts the worth of their portfolios. They have every incentive to own the rights now, while there's still something to own. That's why, even amid unprecedented drought and record-low reservoirs, farmland investment continues to surge. In Wall Street's calculus, the very crisis that devastates farmers makes the assets more desirable. Meanwhile, at the edge of New Mexico ranchlands, a retired farmer named Luis Chavez sums it up. The day they started trading water like stock options, we lost. His family now buys drinking water trucked in from towns 40 miles away. The wells around him have gone silent. Yet the parcels that caused the drain keep climbing in market value because they hold those same extraction rights. This is the core paradox of financialized farming. The same resource that sustains life becomes profitable precisely when it runs short. Profit doesn't come from abundance, it comes from scarcity. And for investors, water scarcity is bullish. In the financial reports of major asset managers, you'll find water stress exposure listed not as a risk, but as an opportunity. They predict rising prices for water-linked real estate and water rights funds. It's a chilling metric, suggesting that ecosystems and balance sheets are now moving in opposite directions. By the time policymakers catch up, the transfer of ownership is often irreversible. Water hoarded for profit rarely flows back into public hands. And because those rights are embedded in farmland titles, they travel with the land no matter who buys it next. Every acre purchased by an investment fund carries both the promise of future yield and the power to unmake communities built around shared wells and rivers. The story of the water connection reveals the full extent of farmland's transformation. It's no longer just about ownership of soil. It's about control of the planet's most fundamental resource. Once financiers realized that, the farmland boom became something much bigger, a global race for the new blue gold. And from here, the story turns toward what happens when this financial water empire merges with industrial agriculture itself. The rise of agribusiness empires. When Wall Street moved into farming, it didn't stop at buying fields. Once financiers owned the land and the water, they wanted control over everything that grew on it too. That's how the age of agribusiness empires began. Corporate conglomerates integrating soil, seed, and supply chain into one machine driven by profit margins instead of harvest seasons. Farming had always been decentralized. A patchwork of family farms dotted the country, each with its rhythms, risks, and rewards. But within a decade, that map changed. Private equity firms and multinational corporations began consolidating farms under their control. They used the same tools they'd perfected in other industries: roll-ups, leveraged buyouts, and debt restructuring, to merge dozens of small operations into a few industrial-scale producers. The logic was straightforward. Economies of scale mean lower costs, and lower costs mean higher returns. So a fund would buy a family-owned grain operation, merge it with its neighbor, centralize management, and cut the workforce. The field stayed the same, but the ownership vanished into a network of shell companies and holding firms. The new landlords weren't farmers. They were portfolio managers chasing quarterly performance. In Iowa, one soybean grower named Ken Walters watched this play out firsthand. His neighbors had struggled with debt after years of fluctuating prices. When a private equity firm offered to buy their operations, it looked like salvation. Within a year, those same neighbors were back working the same land, only now as tenants under strict production quotas. Ken told a reporter, "They call it efficiency. I call it the end of neighbors." These buyouts spread fast. Companies backed by institutional money began acquiring everything from hog barns in North Carolina to almond orchards in California. Each acquisition tightened the grip of a few corporate landlords who leased the ground back to farmers under contracts, as binding as any rent agreement. The farmers paid fixed rents or crop shares, while the owners collected steady, inflation-protected income. The concept mirrored commercial real estate, but instead of office tenants, the occupants were families whose ancestors had once owned the ground. Soon, corporations realized they didn't even need those families. Technological advances, GPS-guided tractors, automated irrigation, and harvest algorithms let one operator manage thousands of acres. Labor costs shrank, production scaled up, and data systems tracked everything from soil moisture to yield projections. A single agribusiness could now manage land across multiple states the way a logistics firm manages warehouses. Behind the curtain, private equity giants moved in silence. Fund managers with backgrounds in real estate or mining suddenly presented themselves as agriculture innovators. Their pitch: agriculture wasn't about farming, it was about optimizing assets. Tractor fleets became mobile capital infrastructure. Crop planning turned into data-driven operations management. The language of cultivation gave way to spreadsheets. Investors weren't just speculating on crops, they were restructuring the entire idea of farming. Public money fueled the rise. Billions in federal subsidies, originally designed to protect small farmers from the volatility of crop markets, flowed into corporate accounts. Because subsidies attached to acreage, not ownership structure, conglomerates collected payments for the same land that family farmers once depended on for survival. A program meant to stabilize communities now quietly propped up financial yield. Farm policy didn't adapt fast enough. Legislators celebrated consolidation as modernization. Politicians spoke about feeding the world through innovation, while ignoring that innovation increasingly meant dispossession. Under this banner, conglomerates absorbed grain elevators, fertilizer suppliers, and distribution chains. The result was vertical integration. From seed patent to supermarket shelf, corporate interests controlled each link. For the farmers still operating independently, the squeeze was relentless. Seed costs, equipment prices, and rent rose faster than commodity prices. Debt followed. Banks, many now partnered with agribusiness lenders, offered refinancing packages that tied farmers to mandatory supply contracts with corporations. Miss a payment, and the same company providing seed could claim your harvest as collateral. The freedom of owning a farm turned into the burden of managing debt for someone else's empire. Meanwhile, agribusiness giants advertised sustainability. Company brochures showed green fields and smiling workers while reporting record profits. They claimed efficiency reduced waste and stabilized food supplies. But efficiency came with a price. Monocultures replacing diverse crops, heavy chemical dependency, and soil degradation from continuous short-cycle planting. In the drive to scale, the land lost its rhythm. Across rural America, consolidation hollowed out communities. Local equipment dealerships closed, replaced by regional branches owned by conglomerates. Independent grain elevators disappeared as processing centers merged. School districts shrank when families moved away. A century of self-reliance eroded into corporate dependency. Places that once defined the national identity became production nodes in global supply networks. Inside the companies controlling these networks, decisions revolved around one metric: return on invested capital. When commodity prices dropped, managers didn't tighten belts or wait out a bad season. They sold assets, merged divisions, or automated labor. Farming wasn't unpredictable anymore because risk had been outsourced to those still working the soil. The investors only needed the numbers to make sense on quarterly reports. You can trace the turning point to the moment agriculture stopped being measured in acres and started being measured in EBITDA. Once financial firms could prove that farmland profits matched or beat real estate, the industry flooded with capital. Between 2001 and 2002, the largest 10 agribusiness firms tripled their asset bases through acquisitions. They bought processing plants, seed genetics companies, equipment manufacturers, and even digital platforms that track farm data. The goal was total integration, a farm without farmers. For example, a private equity group might own the farmland, lease it to another firm that manages operations, buy inputs from a subsidiary seed company, and sell the harvested grain through a trading arm, all under one corporate umbrella. Profits circulate upward, debt and risk stay on the ground. That structure mirrors the leveraged systems that once fueled Wall Street's housing boom. Except now, the underlying asset grows food instead of providing shelter. The human toll often goes unnoticed. A fifth-generation wheat farmer in Kansas named Miriam Holt described her lease terms after her land was acquired by a corporate buyer. Every line was about yield, not about soil care. I asked if I could leave some fallow fields to recover. They said it's not in the model. Within 2 seasons, her topsoil eroded under relentless planting. When yields dropped, the company canceled her lease. The new tenant arrived with deeper pockets and the same mandate: produce or be replaced. Each transaction strips away another layer of autonomy. Cooperative markets that once gave farmers shared bargaining power now face buyouts. Food distributors consolidate, narrowing options for small producers. The result is a quiet return to a feudal structure, workers bound not by law, but by economics. They own the labor and the debt. Their employers own the means and the margins. It's tempting to believe technology or innovation will fix this, but those same buzzwords often hide the consolidation itself. Precision agriculture, satellite imaging, and AI-driven irrigation are useful tools, but they're expensive, and ownership of that technology rests with the largest players. Software replaces experience. Algorithms decide planting schedules. The digital revolution that promised empowerment delivers control to whoever owns the system. Community leaders try to adapt. Some rural cooperatives experiment with shared ownership models or local financing pools. Others campaign for antitrust enforcement to limit further consolidation. But after decades of deregulation, reversing the trend feels like shouting into the wind. As long as farmland and its produce are valued primarily in financial terms, the corporate landlords will remain. Still, every empire carries its pressure points. With ownership so concentrated, any shock, climate events, trade disruptions, or falling commodity prices can ripple through the entire structure. When profit expectations clash with environmental limits, the cracks widen. Yet for now, these agribusiness giants stand as monuments to a simple formula. Control the land, control the output, control the profits. What's unfolding across the countryside isn't just corporate growth. It's the privatization of the food chain itself. Behind every grocery store shelf lies a network of contracts linking seeds to shareholders. The independence that once defined American farming has been replaced by efficiency managed from afar, where balance sheets dictate planting decisions miles from the fields they affect. And once the land, water, and crops are bound together under finance, speculation is the only frontier left. Farmland as a commodity. By the dawn of the 202s, farmland was no longer just a piece of earth. It was a ticker symbol. The same fields that once grew wheat and soybeans now underpin new financial products designed for investors who'd never set foot on a farm. For Wall Street, this was the next evolution. Farmland as a fully tradable commodity, an asset to be sliced, packaged, and sold. The transformation was subtle at first, presented as an opportunity for retail access to agricultural real estate. But underneath the polished language was the same mechanism that once turned mortgages into securities. The model started with farmland investment funds. Firms like Gladstone Land and Farmland Partners created publicly traded REITs that owned farmland across the country, renting it to operators and paying investors dividends from those rents. In earnings calls, executives spoke about portfolio composition and geographic diversification, not irrigation or soil quality. For investors, farmland became another line item on their asset allocation chart, a tool for balancing risk, not feeding people. A farmland REIT owns hundreds of parcels scattered across states. Almond orchards in California, cornfields in Illinois, berry farms in Florida. Those parcels generate cash flow through leases. Shareholders earn income the way they would from office buildings or apartment complexes, except the tenants are farmers paying rent in seasons instead of months. The appeal was clear. From 1992 to 2023, privately held farmland averaged roughly 11% annual total returns, rivaling stocks and outperforming bonds. As this template proved profitable, new products emerged. Private funds, crowdfunding platforms, and fintech startups promised to democratize agriculture. Websites invited small investors to buy fractions of a farm for as little as $10,000. It sounded noble, helping people own a piece of America's soil. But what they actually bought were securities backed by farmland deeds. The structure mirrored fractional real estate ventures. Investors pooled capital, companies purchased land, revenues flowed through rental income and appreciation. Ownership, once physical, became digital. To seasoned financiers, this financialization made perfect sense. Farmland's key attributes, limited supply, stable production, and inflation correlation, fit perfectly into the modern portfolio theory playbook. Institutional presentations showcased farmland's low volatility and steady yields against benchmark indexes. Analysts at advisory firms even coined new phrases: agricultural alpha and soil-based stability. The earth had become an equation. But when numbers define value, speculation follows. The first wave of farmland securities performed well, attracting pension funds and insurance companies hungry for refuge from volatile equities. As demand surged, so did the price of the underlying land. In certain regions, farmland prices rose 40% in under 3 years, far faster than agricultural incomes. That discrepancy didn't deter investors, it encouraged them. Rising prices validated the thesis that farmland could only appreciate. It was self-fulfilling optimism, nearly identical to the logic that fueled the housing boom before 2008. Once securitization began, innovation accelerated. Firms experimented with farmland bonds and exchange-traded funds tracking indices of agricultural real estate. In one promotional video for a farmland ETF, a narrator framed farmland as the new oil, limited, essential, and global. The sales pitch wasn't about food, it was about scarcity. The fewer acres available, the greater the financial premium. Investors weren't buying farms, they were buying a story of permanence in a world of uncertainty. Inside conference halls, farmland investment summits grew popular. PowerPoint slides presented yield curves alongside photos of sunlit fields. Speakers compared soil values to gold reserves, emphasizing that both came from the ground and both hedged against inflation. In practice, the new asset class behaved like any speculative boom. Capital flooded in faster than the real economy could absorb. For example, consider a pension fund managing retirees' portfolios. It invests $100 million into a farmland partnership owning Midwestern cropland. The partnership packages its holdings into shares redeemable on secondary markets. An investor in London or Singapore can now trade exposure to American farmland without ever seeing it. Price becomes abstract, driven by perception and liquidity rather than crops or rainfall. A bad harvest doesn't significantly dent valuation because investors care more about long-term appreciation than seasonal yield. The farmland's productive reality no longer dictates its price. Financial sentiment does. This detachment spawned new feedback loops. Rising valuations allowed funds to borrow more against their portfolios, using farmland as collateral to buy yet more farmland. Each purchase pushed prices higher, justifying further leverage. The process echoed the pre-crisis housing market, where asset-backed securities multiplied faster than underlying value. Farmland wasn't at that scale, but the direction was eerily familiar. One agricultural economist from Iowa State described the shift bluntly. We stopped asking what the land can grow and started asking what it can borrow. The farmland REIT model, while transparent on paper, encouraged debt layering because agricultural assets appeared so stable. When interest rates were low, that stability made borrowing almost risk-free. As rates rose in the mid-202s, some funds found themselves overextended, facing margin pressure not unlike mortgage lenders once did. Yet few investors noticed because the story of farmland's never-ending appreciation remained persuasive. In promotional materials, farmland fund managers used sleek infographics to sell the dream. A typical deck promised double-digit total returns, natural inflation protection, and tangible asset exposure. Nowhere did it mention that tenant farmers bore nearly all operational risk. If yields fell or drought slashed production, rents still had to be paid. Farmers carried the volatility, investors collected the stability. Wall Street didn't invent this imbalance, it refined it. Agricultural economies have always shifted power upward, from laborers to landowners. But now, those landowners were spreadsheets and conglomerates, not individuals. The securitization process anonymized accountability. When a tenant farmer defaulted, the foreclosure wasn't imposed by a person. It came from a system executing contracts. A Kansas wheat grower who missed a single payment due to drought found his lease terminated by an algorithm tracking performance efficiency. The land was released to a larger operator that promised higher yield benchmarks. Automation enforced hierarchy. As securities multiplied, regulators hesitated. Farmland markets had little precedent for large-scale financial products, and oversight agencies lacked jurisdiction. There were no equivalents to mortgage-backed security ratings or capital reserve requirements. Instead, farmland funds operated under real estate investment exemptions, allowing rapid expansion. Lawyers structured deals in ways that skirted banking rules, calling farmland assets agricultural infrastructure. It was a loophole wide enough for billions to flow through. Investors rationalized the influx as beneficial to rural economies. They argued that capital investment modernized agriculture, introducing technology and efficiency. And in some cases, they were right. New irrigation systems, renewable energy projects, and improved logistics took shape. But those upgrades served return metrics, not community resilience. When global commodity prices dipped, funds simply shifted strategy, selling properties or converting them for non-farm uses like solar leases or logistics hubs. The farmland became a flexible asset, its purpose changing with market cycles. By mid-decade, the boundary between farmland finance and general real estate dissolved completely. Major asset managers folded agricultural divisions into their broader property portfolios, analyzing farms alongside warehouses and data centers. Quarterly reports mentioned agribeta exposure next to urban logistics yield. The language erased any distinction between a wheat field and a parking lot. This blending of categories transformed perception. Media headlines celebrated farmland ETFs as sustainable investments benefiting from megatrends in global consumption. Sustainability became a branding tool, a way to attract climate-conscious capital while maintaining the same profit-driven structures. The pitch promised ethical dividends, make money while feeding the world. Yet behind the slogans was the same speculative cycle that had destabilized other markets. When investors profit from price movement more than productivity, volatility is only a matter of timing. On the ground, farmers saw it differently. Lease terms grew shorter, rents grew higher, and decisions about crop rotation or soil regeneration now required financial approval. A Nebraska farmer summed it up. "They treat my land like a bond. Bonds don't need rain." For Wall Street, farmland's beauty lay in its persistence. Crops might fail, but land endures. That durability made it ideal collateral. Funds bundled acreage into asset pools to back loans, just as mortgages had once supported debt instruments. Banks extended credit lines secured by farmland portfolios, betting prices would keep climbing. The system didn't yet show cracks, but old-timers recognized the pattern. In the 198's farm crisis, excess debt had wiped out thousands. History, it seemed, was patient enough to repeat itself. In analyst memos, one phrase appeared again and again. Farmland is the new oil. On the surface, they meant it as praise, describing an indispensable, finite commodity with global demand. But the comparison carried a darker parallel: boom, bust, and the environmental cost of extraction. The soil that had sustained generations was now another tradable unit of value, a means to hedge inflation and speculate on scarcity. The harvest wasn't grain anymore, it was return on equity. This phase of the story closes not with a crash, but with momentum. Farmland securities continued trading, funds kept expanding, and investors applauded quarterly gains. Yet beneath the charts and presentations, the same structural tension grew. Speculative capital built on the expectation that food-producing land would always rise in price. To understand how fragile that assumption is, all we need to do is look back at the last time an essential asset was treated as risk-free property on paper: the housing market before 2008. Because the next chapter in farmland's journey would replay that model with different consequences. The housing model replayed. The story of farmland's financialization might sound new, but its script is eerily familiar and dangerous. We've lived it before, in 2008, when houses stopped being homes and turned into speculative chips. Back then, the promise was safety. Wall Street said mortgages were solid because everyone needs a roof. Now the same mantra echoes with food. Everyone needs to eat, so farmland must be safe. But safety isn't value, and when money forgets that, collapse is never far behind. Let's rewind to that housing boom. Banks issued loans faster than regulations could keep up. Mortgages were bundled, sold, and leveraged into complex securities that investors didn't fully understand. The system ballooned, multiplied by speculation and blind optimism, until cracks appeared. When home prices dipped just a few percent, the entire financial architecture imploded. At the root of that collapse wasn't housing itself, but the separation between a basic human need and its financial abstraction. The same separation is happening now, acre by acre, across American farmland. After 2008, farmland was hailed as the anti-bubble. It hadn't crashed, it produced tangible goods, and its long-term returns looked steady. But within a few years, that story mutated. Investors who wanted predictable yield relied not on agricultural productivity, but on constant price appreciation. Their returns depended on farmland prices continuing to rise regardless of what the land actually produced. When income falls behind valuation, just like mortgage payments once lagged loan values, the results aren't sustainable. A Wisconsin farm appraisal in 2023 made it plain. Land values had doubled since 2001, yet profits per acre barely moved. Yields hadn't grown and costs hadn't dropped. The only thing rising was speculative cash. Analysts started using a polite phrase, decoupled from fundamentals. What they meant was simple. Paper profits were replacing harvests. The financial engineering unfolded the same way it had with housing. Investment funds borrowed against existing farmland portfolios to finance new acquisitions. Banks offered credit lines secured by land whose valuations were based on other inflated sales. Each new purchase validated the next, reinforcing an illusion of ever-expanding wealth. Even small community lenders got pulled in, offering aggressive loans backed by collateral they assumed would never lose value. Sound familiar? It should. It's precisely how subprime lending began. Confidence built on top of confidence, stacked like dominoes. At conferences, farmland fund managers pitched their products as agricultural mortgage-backed securities. The phrasing was meant to inspire confidence. But those portfolios behaved just like housing derivatives. They bundled unpredictable assets, diversified risk on paper, and magnified it in practice. If a drought or trade war erased farm revenues across a region, the ripple effect could hit every investor holding exposure to that land. Yet prospectuses continued to promise stable yield through appreciation. The resemblance to pre-crash mortgage advertising was uncanny. The human angle makes the comparison even sharper. In the mid-2000s, homeowners who missed mortgage payments faced foreclosure by distant lenders who'd never seen their neighborhoods. Today, tenant farmers who fall behind on rent face eviction from investors who've never seen their fields. The terms are different, but the power dynamic is identical. Those working the asset carry the risk. Those owning it collect the returns until the system falters. One agricultural economist in Illinois put it bluntly: "We've replaced subprime borrowers with over-leveraged farmers." Rising interest rates make that burden heavier. As central banks tighten policy to fight inflation, farmland funds relying on cheap credit find margins shrinking. Some respond by raising rents or cutting leases short to reprice higher. Others offload properties to new investors, passing the inflated asset to the next buyer. Just as mortgage originators once flipped risky loans before defaults showed up. Another parallel lies in narrative psychology. Before 2008, the phrase "real estate always goes up" justified almost any risk. Today its cousin, "they're not making more land," does the same for farmland. The slogan feels true, yet it hides the complexity underneath. Climate change reducing arable acreage, water shortages limiting productivity, and shrinking rural populations. But just like housing before its crash, facts don't matter when faith in perpetual appreciation drives demand. In both markets, detachment from use value becomes the quiet signal of danger. Houses stopped being places for families, they became balance sheet entries. Farms stopped being places of work, they become yield-optimized arbitrage. And as speculative capital floods in, new derivatives appear. Platforms have already introduced farmland-linked debt swaps and tokenized farm shares for digital trading. It's the securitization cycle repeating in real time, fueled by technology that lets money move faster than regulation. There's another echo too: moral hazard. Lenders and asset managers often bear little consequence if the system stumbles. They earn management fees on assets under management, not on long-term outcomes. During the housing boom, brokers said, "We'll sell the loan before it fails." In the farmland boom, managers say, "We'll sell the parcel before the market softens." When profit comes from movement rather than stability, collapse is a matter of timing, not possibility. Some attempt to deny the comparison. They argue the farmland market is less leveraged, therefore safer. And for now, that's partly true. Farms don't carry the same debt ratios as mortgages once did. But leverage isn't just official loans, it's exposure. Pension funds, private equity, and REIT shareholders are all financially dependent on continuous appreciation. If prices plateau, expected yields vanish. Even a modest dip could trigger widespread selling, because portfolios designed for endless growth tolerate no stillness. To see what that might look like, remember rural America in the 198s. Land prices collapsed after interest rates spiked. Thousands of farmers lost everything. The difference today is scale. Back then, local banks held most loans. Now global funds hold the deeds. A downturn wouldn't just devastate communities. It could ripple through pension portfolios and sovereign wealth funds worldwide. When farmland becomes financial collateral, the stakes expand beyond agriculture. The most uncomfortable truth is that the machine feeding this boom depends on scarcity and fear. Investors talk about food insecurity, climate risk, and inflation as reasons farmland is valuable. But those very risks are worsened by speculation. When land prices soar, new farmers can't enter. When investors hoard acreage, local food systems weaken. The crisis narrative that attracts money also ensures it never leaves. As one advisor confessed off-record at an investment summit, "We don't want another housing crash, but honestly, the playbook works." He meant the system of converting necessity into opportunity, ignoring long-term cost. And that cost is beginning to show. Small farmers forced to sell become tenants subject to rising rents. Local food prices climb alongside asset values. The ground itself becomes a source of inflation. It's a feedback loop without a natural endpoint. Critics within agriculture warn that if the next shock hits, whether from rising rates, a commodities downturn, or climate disruption, the unwinding could be brutal. Institutions might dump millions of acres onto the market, flooding supply and slashing land values. Suddenly, funds that promised steady yield would scramble to cover losses, echoing the mortgage sell-offs of 2008. The pain wouldn't stay on Wall Street. It would seep into every grocery aisle. Because speculation in farmland isn't abstract. It decides the price of dinner on your table. When land values follow Wall Street's mood swings instead of crop yield, ordinary families fund the volatility with every checkout swipe. Housing bubbles take homes. A farmland bubble threatens the meal itself. Still the cycle spins, security traded for speed, ownership for illusion. One rural banker in Iowa summed it up in a single line. "We turned farms into assets for the same reason we turned houses into chips. It was easy money." And as history shows, easy money never stays easy for long. The price trap. By the time farmland turned into an investment vehicle, the effects were showing up not in the fields, but in grocery aisles. When corporations control both land and production, the price of food stops following weather or harvests. It starts following earnings reports. This is the quiet shift that most people never see. The path from soil to shelf no longer ends with the farmer. It ends with investors deciding how much profit the world can pay to eat. At its core, the price trap begins with ownership concentration and ends at your wallet. When a handful of firms control vast slices of farmland, they quietly control supply. That power shapes every step from seed contract to supermarket shelf. Independent farms once kept prices honest. Now, with competition stripped away, prices drift upward on command. For shoppers, it's inflation. For Wall Street, it's predictability. Across the 202s, researchers charted how consolidation tracks with price increases. In regions where corporate landlords dominate acreage, staple foods, grains, dairy, and meat showed steady inflation above national averages. It wasn't weather. Yields per acre remained consistent, sometimes higher thanks to technology. The difference lay in markups, logistics contracts, transportation networks, and retail positioning that favor vertically integrated companies. When the same entity owns production, processing, and shelf space, prices move less with cost and more with strategy. One agricultural economist called this profit margin harmonization. In plain language, it means firms coordinate to keep profits level across the chain. A processor raises its margin, distributors follow, and retailers adjust shelf prices to maintain symmetry. Instead of competing, they align. Consumers rarely notice the choreography because it's hidden behind seasonal excuses: drought, energy costs, supply chain delays. Yet corporate filings reveal record net margins even during those supposed disruptions. The pattern became clearest during recent supply shocks. While families cut back on groceries, agribusiness shareholders enjoyed their most profitable quarters ever. Take global grain traders. During pandemic shortages and the early energy crisis, their profits doubled. The same held for fertilizer giants and packaged food conglomerates. Prices rose faster than costs, proving that scarcity wasn't driving inflation, ownership was. Algorithmic pricing systems cemented this further. Large grocery chains now use dynamic pricing software tied to supply forecasts and competitor behavior. Those systems aren't run by shopkeepers. They're managed by data analytics firms linked to the same investors behind farmland funds. Algorithms analyze consumption data and adjust prices to maintain optimized profitability. If one supplier reports reduced yield, the system raises retail prices across multiple regions instantly, even if local supply hasn't changed. Inflation becomes coded into the sales software. Meanwhile, consumers are told the increases reflect global forces instead of engineered profit extraction. Think of how airline seats fluctuate in real time. Now food behaves the same way. Milk, eggs, and vegetables turn into price-responsive commodities, with margins managed digitally. The public blames inflation or politics, while corporate owners quietly synchronize returns. Farmers feel it differently. As landlords raise rents to cover rising interest costs, tenants must charge more for crops or face losses. But they have little leverage. Most sell to processors through contracts that lock in prices months ahead. If the market moves, gains go up the chain, not to the fields. The farmer's share of each grocery dollar keeps shrinking. In 198, they earned about a third. Now it's less than 15 cents. The rest fuels logistics, marketing, and financial management layers that turn production into profit. Some economists argue this isn't collusion, but market efficiency. They say consolidation removes waste. Yet efficiency for investors means fewer hands on the soil and tighter control over output. If one conglomerate can influence both supply and distribution, food prices stabilize not around fair cost, but around target yield curves. The result is inflation that behaves like dividends, a steady upward drift priced into expectations. Look at what happened with meatpacking. For companies now process more than 80% of U.S. beef. When they raised wholesale prices after pandemic closures, they blamed labor shortages. But internal reports later showed capacity rebounded within months while prices stayed high. Every link in the supply chain adjusted upward and never came back down. It's the ratchet effect. Once profitability climbs, it rarely reverses. Farmland ownership provided the leverage that made it possible. Land consolidation also skews subsidies, quietly propping up these higher costs. Federal support meant to protect small operators now flows to conglomerates renting hundreds of thousands of acres. Those payments offset production expenses, letting large owners maintain inflated prices without appearing exploitative. On paper, the subsidies support agriculture. In reality, they protect investor margins. Public money keeps private profit stable. Consumers bear the invisible tax. Rising grocery bills funnel cash into the same funds holding farmland equities. Retirement portfolios, index funds, and institutional investors profit each time grocery spending climbs. That creates a perverse loop. Ordinary people paying higher prices indirectly boost their own pension balances, but only marginally. The majority of the gain concentrates at the top among those already owning the food chain. In this structure, scarcity is no longer an emergency, it's a business model. When droughts hit or supply falters, investors treat it as proof of value. Asset managers highlight resilient revenue amidst volatility. Share prices rise because consumers have no choice but to keep buying. It's the same psychology that turned oil shortages into windfalls for producers. Except now the commodity is dinner. The irony deepens when you consider productivity. Modern farms produce more food per acre than ever, yet grocery costs keep climbing. Economists call it decoupling of yield and price. The gap between abundance and affordability widens because ownership consolidation removes competition. 2. Maintain profitability. Companies simply price upward. Regulators struggle to prove wrongdoing because each stage looks rational in isolation. Only when viewed together does the system reveal itself as orchestrated inflation. One former executive from a major agribusiness described internal meetings where analysts modeled price scenarios not against cost, but against consumer tolerance. "We'd test how far we could go before shoppers switched brands," he said. The land value under our supply contracts told us exactly how much runway we had. In other words, farmland valuations weren't passive. They dictated food prices by defining acceptable margins. This is the trap's cruel efficiency. Farmers can't lower costs without losing leases, consumers can't find alternatives, and governments subsidize the difference. Everyone moves within boundaries set by landowners who face minimal risk. When storms wipe out harvests, crop insurance, backed by taxpayers, covers losses. When markets swing, algorithmic pricing cushions revenues. The volatility that once defined farming becomes predictable for investors, but unbearable for everyone else. During recent global crises, these patterns hardened. In 2022 and 2023, grocery inflation hit multi-decade highs. Analysts blamed fuel and shipping, but Fortune 500 agribusinesses reported record profits. They used those windfalls to buy more land, further concentrating future control. The feedback loop locked tighter. Profit funds acquisition. Acquisition creates scarcity. Scarcity justifies price hikes. Farmers, consumers, and even smaller corporations orbit around a few financial suns. The emotional impact in rural America goes deeper than economics. For generations, farmers understood price swings as part of nature: rainfall, pests, markets. Now they face invisible forces they can't predict or influence. A Midwest grain grower checking commodity prices online might see futures spike overnight due to investor sentiment, not weather. His input costs rise instantly while his sale price remains fixed. "It's like they're farming us," he says, half joking. Behind the humor lies exhaustion. What once functioned as an open market has become an engineered environment optimized for capital extraction. Small grocers close under supplier pressure. Regional distributors vanish. Consumers end up with uniform brands sourced from identical supply chains. Variety gives way to reliability, reliably profitable. That is, the true cost of food isn't measured in dollars, it's measured in dependency. Regulators occasionally gesture toward reform. Hearings are held on meatpacking competition, land concentration, and algorithmic pricing. Yet enforcement remains limited. Lobbying by agricultural conglomerates outpaces public oversight budgets many times over. Financial firms argue that farmland investment brings modernization and resilience. They rarely mention that resilience now means adapting not to climate, but to profit targets. The future these structures create looks deceptively calm. Grocery shelves stocked, farms digitally managed, investors pleased. But beneath it is fragility, a system where prices rise because they must, not because they should. Every dollar extracted from a shopper's wallet validates the model further. When the next disruption hits, the same logic will turn crisis into opportunity again. In this new food economy, the invisible hand doesn't guide, it grips. Markets still move, but their purpose is flipped, to protect asset valuations, not nutrition. That's the real price trap. Escaping it starts with one question. Does the market serve the people who eat, or the investors who own the ground beneath their dinner? The disappearance of the farmer. By the late 202s, farmland speculation had erased the line between investment and inheritance. The people who once defined the countryside were no longer its owners. Rural maps still showed family names, but the deeds belonged to holding companies with addresses in Delaware or Singapore. On paper, America was still an agricultural power. In reality, its farmers were vanishing. The change wasn't sudden. It happened every time someone like Mark Davis watched a corporate bidder outspend a family that had worked its soil for generations. At first, those stories sounded isolated, bad luck or poor timing. But patterns emerged. County assessor records showed the same shell companies buying dozens of neighboring parcels, each sale driving up the next. Families who had survived droughts, floods, and fluctuating commodity prices couldn't survive Wall Street. Within a decade, independent farmers became tenants on the same fields that bore their last names. Across Iowa, Kansas, and the Delta, for lease signs replaced mailboxes. Corporate landlords offered short-term leases with yield benchmarks and digital reporting requirements. Farmers became contract workers managing assets they didn't own. They paid rent indexed to inflation, absorbing risk without building equity. Many compared it to the tenant systems their grandparents escaped a century ago. The irony wasn't lost on them. One couple in Illinois, Diane and Harold Lewis, had farmed 800 acres their grandparents carved from prairie over a century ago. When fertilizer costs soared and the bank refused another loan, they sold 600 acres to a pension fund subsidiary. The contract let them stay on as tenants, guaranteeing operational continuity. 2 years later, the new owner raised rent 20%. Diane said, "We harvest for someone else now." It feels like sharecropping with better paperwork. That paperwork hides a cruel statistic. By the end of the decade, fewer than 2% of Americans directly worked in agriculture, and most no longer owned the ground they tilled. Census data described operator decline, a sterile phrase concealing human loss. Young people left because they couldn't afford land. Older farmers sold out because they couldn't retire otherwise. Each sale hollowed another community. Rural towns shrank not from disaster, but from mathematics. When ownership vanished, so did agency. Local banks closed after losing borrowers. Farm supply stores turned into distribution hubs for national chains. Schools consolidated as families moved to cities. In places like western Nebraska, whole townships reverted to prairie because no one lived there anymore. Satellite images showed green rectangles of irrigated megafarms surrounded by empty roads. The countryside looked productive from above, desolate on the ground. Sociologists call it ownership displacement. To residents, it feels simpler, being erased. One farmer in Oklahoma told a reporter, "My granddad fought to keep this place during the Dust Bowl. He'd never believe I lost it to investors who've never seen dust." What used to be generational continuity became a one-generation lease cycle. Each renewal felt like a reprieve instead of a right. The collapse isn't just economic, it's psychological. Farming once meant autonomy, pride, and a direct connection between effort and result. Now, performance metrics determine worth. Corporate landlords collect weekly drone data, showing plant health and moisture. If yields fall below modeled targets, tenants risk losing contracts. For farmers, the pressure resembles warehouse fulfillment quotas more than seasons of growth. The job title remains the same, the meaning doesn't. Work that once followed nature's rhythm now follows spreadsheets. Leases start on fiscal years, not planting calendars. Investors publish quarterly updates comparing portfolio yield to commodity benchmarks. Somewhere inside those reports are human lives reduced to line items. Underperformance in Midwest leases due to weather variability. That sentence might represent a family's entire livelihood. Debt deepens the trap. To stay competitive, tenant farmers lease more acres or invest in precision equipment financed through the same banks partnering with agribusiness landlords. Miss one payment, and the repossessed combine goes straight to the company store, resold or leased again. Farmer debt swells while ownership equity disappears, a reversal of the model that sustained rural economies for a century. The generational chain breaks here. Fewer children inherit farms because there are no farms left to inherit. College agriculture programs report enrollment declines as students pivot to agribusiness management instead of production. The identity of farmer shifts from doer to overseer. In some regions, corporations advertise openings for farm operators, the same way factories list machine technicians. For the communities around them, that shift tears more than nostalgia. Churches close, co-ops dissolve, and local governance weakens. When fewer residents own land, fewer pay property taxes directly. Voting power flows to absentee owners represented by attorneys rather than neighbors. Policy once shaped by farmers now answers to investors who measure success in yield per share. Rural democracy withers alongside ownership. At the same time, media narratives celebrate innovation. Drone footage of vast, automated fields runs in business magazines under headlines about efficiency and progress. To someone in a city apartment, it looks like advancement. To those displaced, it looks like erasure turned into spectacle. Progress sounds brighter when you're not the cost. Some farmers resist through cooperatives that pool resources to purchase land collectively. Others turn to regenerative methods outside traditional finance, relying on community-supported agriculture or local investors. These efforts inspire, but they operate inside a tilted system. Competing with billion-dollar funds using public subsidies and tax advantages is like trying to outbid gravity. The scale difference alone keeps most resistance symbolic. Still, within that symbolism lies meaning. In Missouri, a group of evicted farmers held onto 10 acres and built a shared greenhouse, selling produce directly to nearby towns. Their leader, an older farmer named Clara Jensen, told a local paper, "We lost our farms, not our hands." Stories like hers echo faintly against the larger trend, reminders that culture persists even when property fades. Yet the statistical tide moves one way. Larger enterprises swallow the remainder, rebranding rural zones as agricultural production districts. Workers receive contracts tying wages to yield performance, not ownership. Corporate recruiters call them crop technicians. Their supervisors review satellite metrics from regional offices hundreds of miles away. Farming becomes shift work managed by algorithmic schedules and remote analytics dashboards. As labor contracts replace family ownership, wages stagnate. Benefits vanish because workers are classified as seasonal contractors. Immigration policies fill the gap with temporary foreign labor programs. Town accents change, communities fragment. The United States still produces enormous quantities of food, but fewer citizens have any stake in producing it. The country that once bragged, "We feed the world," now leases the right to feed itself. For remaining independent farmers, the isolation grows. They watch neighbors sell out or age out while corporate trucks haul uniform harvests from leased fields. When they gather at the local diner, and there are fewer diners left, the talk turns to survival rather than legacy. One man sighs, "We used to argue about weather. Now we argue about algorithms." The laughter that follows carries resignation. This isn't a nostalgic tragedy, it's a systemic design. The financialization of land naturally removes those who can't match institutional capital. Just as small shopkeepers disappeared when retail corporatized, small farmers fade when food becomes finance. The market rewards concentration, not stewardship. And as land consolidates, so does narrative control. Reports describe farmers as inefficient legacy operators, reframing displacement as modernization. The psychological cost ripples beyond the countryside. Urban consumers lose connection to food origins, assuming abundance will persist regardless of who grows it. That detachment allows policy complacency. Few realize that when farmers vanish, food resilience goes with them. Lacking local knowledge and adaptive diversity, industrial systems become brittle, optimized for profit, vulnerable to shock. Meanwhile, investment firms celebrate efficiency gains in their quarterly letters. Charts show reduced labor costs and higher average output per acre. Those numbers look like progress until you ask who used to earn that income. Beneath the profits lies a population quietly erased. People whose names no longer appear on deeds, whose stories no longer fit the metrics of success. What emerges is a tenant society in rural form, a landscape owned by corporations, worked by contractors, overseen by algorithms. Independence turns into gig work under open skies. For many, farming still feels like a calling, but answering that call now requires permission from a landlord hiding behind a limited liability shell. Standing on a rented field at dusk, a farmer pauses as automatic sprinklers click on around him. The water arcs over soil his family once owned. The machinery hums on schedule. Satellites watch from above. He wipes his hands, knowing the sensors measure moisture better than he can. Yet none of those systems know him. In tomorrow's reports, his effort will be summarized as data: efficient, compliant, replaceable. Behind him, the horizon glows with distant towers marking the next logistics hub built on former farmland. Ahead, the rows stretch. Flawlessly straight, every line perfect, every human out of frame. The efficiency illusion. By the time investors dominated the countryside, a new word became their shield: efficiency. In reports, conferences, and political speeches, it justified everything: consolidation, automation, even the disappearance of farmers. Efficiency meant progress, and progress was always good. But on the ground, it masked a different truth: that financial power had rebranded control as innovation. Listen to how they talk about it. Agribusiness executives call themselves stewards of productivity. Private equity managers describe farmland portfolios as optimized ecosystems. In place of farmers, they say operators. In place of communities, they say scalable networks. Every term flattens the human texture of agriculture into measurable inputs and outputs. When questioned about rural decline, they smile and reply that modernization always disrupts. We're feeding more people with fewer resources, they argue, as if efficiency alone could erase inequality. At first glance, the numbers even seem to agree. Acreage yields climb. Labor hours drop. Output per worker hits record highs. Satellites monitor fields every day. Sensors adjust irrigation by the minute. Yet total food affordability slips, soil health deteriorates, and rural poverty deepens. The paradox is plain. The more efficient the system becomes, the less it nourishes the people within it. Executives insist this is temporary, a transition phase. They point to technology as salvation. Drones, robotics, and AI should reduce waste and increase yield. Ag-tech startups pitch themselves as saviors solving hunger with code. Venture funds swarm the sector, promising tools that will democratize farming data. But the ownership of those tools traces back to the same capital groups controlling the land. The new machines don't empower farmers, they entrench dependence. Imagine a family leasing land from an investment trust. Their contract requires adoption of specific software to monitor soil and moisture. That software is licensed by a subsidiary of the same fund. Data from the farm is uploaded daily, analyzed remotely, and used to adjust next season's rent based on predicted yield. The tenant pays 3 times, once to rent the land, once for the tech required to run it, and once through data that improves the landlord's next forecast. Efficiency becomes surveillance disguised as innovation. Agritech firms champion precision agriculture, claiming it prevents overuse of water and fertilizer. In practice, those sensors help enforce production quotas and flag underperforming leases. The more precisely they measure, the tighter control investors exert. What began as a tool to save resources becomes infrastructure for compliance. A farmer in Kansas described it simply. The computer thinks faster, but for who? Meanwhile, PR campaigns flood social media with pastoral imagery. Hands sifting soil, bright green leaves, slogans about feeding the world sustainably. Corporations sponsor documentaries showing solar-powered tractors and automated greenhouses. The message is clear: high-tech efficiency equals moral virtue. Few viewers realize those tractors operate on land owned by pension consortia in New York or Abu Dhabi. Sustainability sells well when dissociated from ownership. Regulatory agencies echo the same language. Policy papers celebrate economies of scale and technological integration. Legislators cite industry studies, often funded by the very corporations they oversee, that frame consolidation as necessary for global food security. Lobbyists present graphs proving large farms emit less CO2 per unit of food. Missing from those graphs are the emissions from displaced small farms, redundant transport networks, and increased dependence on synthetic fertilizer. The story of carbon efficiency hides the cost of ecological exhaustion. In truth, efficiency doesn't mean doing more with less. It means converting unpredictability into consistent revenue. Nature's irregularities, rainfall, pests, soil regeneration, don't suit quarterly reports. Technology smooths those fluctuations long enough for investors to lock in gains, even if ecosystems strain in the process. When yields level off or climate stress disrupts forecasts, firms relocate capital, not crops. The land left behind bears the real inefficiency: depleted soil and empty towns. Through clever language, losses become virtues. When corporate landlords cut jobs, they call it automated optimization. When local supply chains collapse, they label it logistical consolidation. Even humanitarian initiatives mirror the narrative. Philanthropic foundations fund tech pilots that claim to empower smallholders overseas while investing in global farmland funds at home. The optics harmonize. One hand donates, the other speculates. Inside these dynamics lies regulatory capture. Many agricultural advisors at federal agencies cycle directly into private sector consultancies. Policy drafts for precision farming incentives often draw from corporate white papers. Subcommittee hearings feature testimony by executives whose companies receive the very subsidies under discussion. The revolving door spins smoothly because efficiency provides cover. What bureaucrat dares oppose progress? For investors, this alignment is perfect. Governments subsidize the very systems that guarantee corporate returns. Grants for water-saving technology funnel into hardware purchases managed by the same agritech giants leasing the fields. Carbon credit markets reward companies for using digital monitoring, data they already collect. Efficiency morphs into a revenue stream layered atop agriculture, turning ecological crisis into a new portfolio category. Consider how analysts describe drought. Where farmers see threat, investors see price opportunity. Reports praise adaptive monetization of climate volatility. In other words, as the planet warms, the assets tied to resource scarcity become more profitable. The market's moral compass flips. The worse the outlook for the environment, the stronger the case for owning its remnants. Profit justifies every predicted disaster as potential yield growth. Inside boardrooms, discussions sound like corporate strategy sessions, not agricultural planning. A presentation slide might read, "Leveraging climate risk into alpha generation." Another highlights reduced labor exposure via robotics deployment. Beneath the jargon lies simple arithmetic: extract more, spend less, externalize cost. Efficiency provides the moral sheen that turns exploitation into innovation. Yet cracks appear. Soil depletion across heavily financialized farmland is accelerating. Research from Midwestern universities shows nutrient loss rising even as profits climb. Monoculture cycles shorten fallow periods, burning out organic matter. But rather than restore, investors rotate capital to new regions, leaving behind what agronomists call stranded land, fields that can't recover without years of rest. They're the agricultural equivalent of ghost factories. In California, large orchards now rely on predictive models to schedule harvests. Algorithms decide water timing, fertilizer batches, even labor hours. Workers receive text alerts directing them to coordinates. When a model underpredicts yield, fruit rots. When it overpredicts, overtime spikes. Either way, human reasoning has vanished from the loop. "We used to read the trees," one foreman said. "Now we read the app." Productivity metrics rise, but job satisfaction and skill retention collapse. Efficiency has no memory. The public rarely hears these details because corporate communication reframes every outcome as progress. Press releases announce supply chain modernization, without mentioning the closed cooperatives. Reports highlight carbon-neutral facilities, while exporting emissions to contracted transport fleets abroad. Every indicator of social loss transforms into a symbol of environmental leadership. Language launders consequence. The psychological toll stretches further. Farmers and workers measure their worth against machines that never sleep. When sensors declare underperformance, self-doubt replaces pride. Depression and suicide rates in agricultural communities, already high, climb further. Yet the discourse remains fixed on innovation metrics: drone coverage, sensor density, input reductions. Efficiency speaks only in percentages, never in people. Even consumers are enlisted in the narrative. Marketing tells shoppers that higher prices reflect the cost of sustainable production. Labels featuring buzzwords, regenerative, eco-smart, data-driven, reassure buyers that moral eating simply means paying more. The premium flows back through corporate channels to investors measuring brand loyalty as another efficiency ratio. Ethical consumption becomes another layer of monetization. There's a philosophical sleight of hand here. Efficiency once meant balance, doing enough with care for what remains. Now it means eliminating everything that slows capital circulation: rest, diversity, deliberation. In that sense, the system achieves exactly what it intends: perfect conversion of living ecosystems into predictable earnings. It's not broken, it's precise. But precision breeds fragility. A field optimized to millimeter precision tolerates no error. When climate shocks hit, algorithms lack improvisation. When energy costs surge, automated irrigation halts. Communities that once shared risks collectively now wait for corporate emergency plans that prioritize asset preservation over livelihoods. The efficiency that promised resilience delivers rigidity instead. This is the illusion's final form. A future where progress is measured not in nourishment or security, but in throughput speed. Investors, aided by policymakers and technologists, define success as minimizing the distance between nature and profit. Every drop of water, every acre of land, every human gesture becomes a data point in a global engine engineered to run without pause. Efficiency was supposed to feed us better. Instead, it feeds the system that profits from pretending it can. The coming flashpoint. By the early 203s, the map of global agriculture looks nothing like it did a generation ago. Ownership has converged into fewer and more powerful hands. Lines once drawn between financial centers and farm regions have blurred into a single network where capital moves faster than rain. The system works until it doesn't. Beneath the calm of steady returns, pressure is building. Somewhere in that pressure lies the next breaking point. You can already see the warning signs in the soil. Across the U.S. Midwest, soil loss averages 5 tons per acre each year, 10 times faster than nature replaces it. Decades of continuous planting, combined with heavy mechanization, have shaved the land into exhaustion. Analysts describe it clinically as organic matter depletion. But to farmers who still live nearby, it feels like watching the land die of thirst. Where prairie grasses once held moisture, wind now blows thin layers of topsoil into the next county. It's not climate alone, it's efficiency's aftershock. The ecological strain echoes overseas. In parts of Brazil, vast soy plantations financed by foreign funds push into rainforest buffer zones, displacing thousands of smallholders. In sub-Saharan Africa, leasing programs branded as agricultural modernization have transferred millions of acres from local communities to multinational consortia. Governments celebrate the deals as development, yet the food produced often heads straight to export markets or biofuel production. The cycle repeats, profit leaves, depletion stays. Water scarcity reinforces the spiral. The western United States remains locked in drought. In regions like California's Central Valley and Arizona's basins, aquifers sink deeper as investors extract water faster than any natural recharge can replace. The logic is perfectly rational on paper: maximize yield while rights exist, but ecologically suicidal. Satellite data shows entire valleys sinking from subsidence. Once the ground caves, so do the surrounding infrastructures, canals, roads, wells. Repair costs fall on taxpayers, not portfolio holders. It's the ultimate privatization of risk. Meanwhile, global demand for food keeps rising. 10 billion mouths projected by mid-century create an irresistible narrative for continued expansion. Policymakers and investors alike frame every environmental concession as unavoidable sacrifice to feed the world. Yet hunger grows too. The United Nations reports that more than 700 million people face chronic undernourishment even as agribusiness profits reach record highs. The paradox is structural. Food scarcity generates higher margins than abundance. For a system tuned to maximize return, crisis isn't an error, it's performance. In this landscape, farmland doubles as geopolitical leverage. Nations once importing grain now seek control of production abroad. China, the UAE, and Saudi Arabia lease or buy land across Africa and South America, ensuring food imports in case of drought at home. Western pension funds follow suit, diversifying sovereign exposure through overseas acreage. Each deal tightens the link between global finance and national food security. A failed harvest in one hemisphere could now ripple through stock markets in another. American policymakers begin to notice the imbalance but respond with the same tools that fostered it: tax incentives and subsidies framed as investment in resilience. Corporate lobbyists craft bills offering deductions for climate-smart agriculture, a phrase so broad it includes nearly anything with sensors or software. The legislation passes easily. Pension funds celebrate new green bond classifications. The farmland bubble inflates further. Few realize those incentives effectively pay investors to accelerate depletion under a sustainability label. In rural communities, resentment simmers. Land once central to civic identity now belongs to absentee owners. Property tax bases erode as corporations secure exemptions. Schools and hospitals close while land values rise on spreadsheets. The contradiction between paper wealth and real poverty pushes farmers toward quiet rebellion. Cooperatives revive community ownership models, crowdfunding to buy back parcels acre by acre. They succeed occasionally, tiny reversals in a tide of consolidation, but mostly serve as moral resistance rather than structural change. Then climate delivers what markets ignore. Successive years of extreme heat scorch the Midwest, harvests crash. Insurance payouts mount, many financed by the same federal programs underwriting corporate landlords. Global grain reserves drop. Futures markets spike to record highs. For ordinary people, it means bread prices doubling within months. For investment funds, it means another windfall. Reports trumpet resilient performance during environmental volatility. Profit grows from scarcity once again. Public patience frays. When news breaks that hedge funds shorted food commodities while raising rents on farmland, protests erupt outside financial districts. Demonstrators hold banners reading, "We eat, you invest." The coverage shocks viewers who never realized food prices were traded like tech stocks. Politicians promise hearings, but face donation records tracing back to the same firms under scrutiny. Reform meets inertia, as always. Internationally, the same volatility fuels tension. Exporting countries impose bans to protect domestic supply. Import-reliant nations scramble to secure shipments through diplomatic pressure or land deals abroad. In dry regions of Africa, foreign-owned farms divert river water to export crops, leaving nearby villages dry. Local activists call it agrarian colonialism, a new partition of resources by capital rather than empire. Governments reply that the investments create jobs. The argument rings hollow amid empty wells. Inside boardrooms, investors debate transition risk, code for the possibility that public anger forces regulation. Some funds launch preemptive initiatives, voluntary transparency reports, ESG certifications, even token land transfers to community trusts. But these gestures function more as brand insurance than systemic change. Asset managers know a fundamental correction would slash portfolio values worldwide. They choose delay. The longer scarcity persists, the more they can monetize it. Academics identify this moment as the edge of a food bubble. Just as real estate once inflated beyond household incomes, farmland prices now exceed the productive value of crops many times over. When interest rates tick higher or yields dip, the calculus falters. Analysts quietly warn of overexposure in pension systems holding billions in agricultural assets. A downturn could cascade across financial institutions already stretched by climate losses. Yet public portfolios keep buying, convinced that food, unlike housing, can't crash because people will always eat. They forget people can't always pay. Cultural response follows crisis. Documentaries expose vanished towns and polluted aquifers. Social movements champion food sovereignty and local ownership. Younger generations, disillusioned by finance, turn toward cooperative agriculture, urban farms, and land-back initiatives. Their projects remain small but symbolically potent, a rejection of extraction disguised as progress. However, these movements rely on the same digital platforms and crowdfunding ecosystems sustained by global capital. Resistance and exploitation share infrastructure. Even rebellion pays rent to the system it opposes. The environmental consequences now stretch beyond national boundaries. Degraded soils emit carbon formerly stored in organic matter. Peatlands drained for large-scale farming release greenhouse gases rivaling those of airlines. Agricultural production, optimized for immediate return, feeds climate loops that make farming itself unstable. In response, investors pivot to climate adaptation funds, new vehicles profiting from the disasters their previous models intensified. Crisis becomes commodity. Still, history suggests markets can't ignore physics forever. When resources collapse faster than valuation models predict, accounting fails. In arid regions of California and the High Plains, water rights expire because there's no water left. Investors sue states for expropriation, claiming violation of property rights. Courts split decisions, sometimes siding with states enforcing conservation, sometimes with corporations demanding compensation. Each ruling redefines where private ownership ends and public necessity begins. This legal conflict marks the true flashpoint, a global reckoning over who controls survival. Because beneath all the financial jargon, the question remains ancient: who owns the means to eat and drink? For centuries, communities believed land and water, though privately used, were collectively vital. Financialization replaced that belief with balance sheets, and now the contradiction is visible. As ecosystems strain, the law must choose between life and ledger. When the next downturn arrives, triggered by climate disaster, credit contraction, or both, the illusion of infinite growth will fracture. Massive funds will offload land to cover losses. Prices will fall, and with them, entire rural economies dependent on high valuations. But collapse may also unlock possibility. Land returning to realistic value could finally re-enter public or cooperative ownership. Whether society seizes that chance depends on awareness built today. The flashpoint isn't a single event. It's an accumulation, the slow ignition of soil loss, water scarcity, food inflation, and social exhaustion. Eventually, numbers stop hiding it. The metrics investors worship, yield, efficiency, appreciation, turn negative. What was once an asset class becomes evidence. The ground literally gives way. If the great land grab defined the last 20 years, the coming decades will answer its question: can a civilization built on financialized food endure its own success? The answer will arrive not in markets, but in harvests, in towns remembered only on survey maps, and in the price of water on a dry morning when rain no longer falls where it once did. What it all means. Mark Davis stands again at the edge of his former field, watching the corporate farm's machines roll across land his family once called theirs. The sun sets behind wind turbines owned by an energy subsidiary of the same investment fund that bought his acreage. To him, and to thousands like him, the numbers never added up. Yields steady, costs rising, ownership gone. The spreadsheets said progress. The horizon said otherwise. His father's old tractor rusts in the shed they weren't allowed to keep. "I thought we'd hand this place down," Mark says quietly. "Turns out we were just renting it from the future." His words carry the weight of everything this story reveals. that financial progress measured in returns has traded permanence for possession. What began as investors seeking stability after 2008 reshaped the foundation of food itself. Farmland became a collateral class. Water became a derivative. Farmers became tenants of unseen shareholders. The moral language of stewardship yielded to the arithmetic of performance. Each acre tells the same quiet story of transformation. Essential life reduced to tradable yield. The pattern mirrors every past crisis of wealth creation. Housing was securitized until the bubble burst. Education was debt-financed until students became balance sheets. Now food, our most elemental need, has followed the same road. Each time, the logic repeats. Privatize necessity, inflate its value, and sell proximity to the pain. When the price climbs high enough, ownership consolidates, and the rest of us rent survival. For Wall Street, farmland promises permanence, a hedge against inflation and chaos. But the hedge cuts both ways. If speculation dictates prices, every storm, drought, and conflict turns into profit while communities bear the risk. The planet becomes a spreadsheet adjusting for volatility that human lives can't absorb. Still, the story isn't fate. Across small towns, co-ops and land trusts are reclaiming pieces of what was lost. Urban farms rise on vacant lots. Indigenous nations press for land-back initiatives. Advocates push legislation to cap corporate ownership and relink subsidies to stewardship instead of scale. These efforts won't reverse everything, but each acre saved breaks the illusion that the system is inevitable. Because inevitability is the final myth finance sells, the idea that markets are nature rather than tools. In reality, they're choices, and choices can change. Treating soil as a portfolio entry or as a living foundation depends on which future we decide to fund. Food, like shelter and water, can't remain commodities without consequence. The next financial downturn won't just rewrite balance sheets, it will rewrite dinner tables. If speculation collapses farmland values the way it once collapsed housing, the impact will reach every household, not through eviction notices, but through grocery prices no government can subsidize away. Mark still visits his old property line sometimes. The hedge his grandfather planted to block the winter wind still stands. Beyond it stretch acres that now belong to people he'll never meet. When the wind shifts, the sound of mechanical planters drifts across the field, a rhythm too perfect, too detached. He looks down at the soil under his boots and mutters, "They own it, but it still remembers us." That memory is the true counterweight to financial abstraction. Land keeps records deeper than ledgers, of work, weather, and identity. Reconnecting to that memory may be the only reform powerful enough to matter. If housing showed what happens when speculation reaches our doors, farmland shows what happens when it reaches our tables. The greed that empties homes can also empty harvests. The next crash won't take your address, it'll take your appetite. If you care who controls the ground that feeds you, keep watching. Subscribe for more stories exposing the quiet frontiers of ownership and see how finance reshapes the world beneath our feet. Because as long as food is traded like stock, everyone eats at someone else's price.